L&T Finance, and they've delivered a solid 27% year-on-year PAT growth in Q4 with an ROA of about 2.4%. Let me welcome on board Sudipta Roy, the MD and CEO at L&T Finance, joining in to talk about exactly that. Sudipta, hi, morning. Great delivery. I was just looking at your PAT and your ROAs. Tell me, what were the drivers and how sustainable does this momentum look into FY27?
Thanks, and thanks for the opportunity to talk to the viewers of ET Now. I think this quarter has seen a culmination of the transformation efforts that we have been carrying on in our organization for the past 24 months. The beginning of FY26 was a little weak for us, primarily on account of the lingering microfinance industry asset quality issue, as well as some of the impacts of the Karnataka ordinance. But however, as we moved through the year, H2 turned out to be significantly better. There was a lot of momentum in terms of disbursement, both on the two-wheeler and the tractor business, on account of the GST 2.0 reforms, as well as the microfinance business completely restored to normalcy. In fact, if I look at collections efficiencies, in the month of March, we crossed 99.8% again, which was almost equal to the pre-crisis levels. And our microfinance business actually has grown on 41% year-on-year. So overall, if you see all our businesses have fired in. Two-wheeler business has grown, disbursement has grown at 58% year-on-year. Our personal loans business, very strong growth, almost 98% year-on-year, though on a smaller base. Loan against property at about 67% growth on year-on-year. Gold loans that we acquired has grown significantly. We did 1,000 crores of disbursement on the gold loan business in the month of March, and when we took over the gold loans business from Paul Merchants, we had 130 branches. Now we have 330 branches. We put about 200 branches in 6 months, almost one branch a day. So actually, every business, the entire organization has fired on all cylinders. And the credit costs actually have secularly trended down. If you look at our slippages, the slippages have come down to roughly from about 900 crores or to about 944 crores to about 402 crores.
Right.
So our credit cost also has inched downwards. Right. Our credit cost previous quarter was about 2.83%. This quarter is about 2.64%. So there has been a secular downward movement on credit cost, and weighted average cost of borrowing also has come down. In fact, we reached the lowest ever weighted average cost of borrowing this quarter at about 7.17%. So overall, all these have stacked up to deliver a good quarter and a relatively healthy ROE of 2.4%.
No, point taken, Mr. Roy. So yes, you've said that there's clear and visible improvement with regard to credit cost and slippages, which is impacting your ROA or benefiting in terms of your ROA. Give us a sense with regard to OPEX, Mr. Roy. It's coming at around 4.14% cost to assets. Give us a sense on how that plays out maybe over the next year or so. Do operating efficiencies really kick in?
See, we still are in the investment mode, primarily because the gold loans business will go through a massive scale-up this year as well. So last year we put 200 gold loan branches. This year we'll put another 400 branches because we intend to scale up this business pretty strongly. Our investments in our AI initiatives, both in terms of software and hardware, continue. So there are investment items, and there are also cost efficiency items as well as credit cost efficiency items that are coming out of the AI initiatives, which we have detailed very clearly in our analyst deck from slides 21 to 23. So overall, as an organization, we have guided that our OPEX plus credit cost will be in the range of about 6.5% odd for probably the next 2 quarters. So right now it's about 4.14% is what our headline of 4.11 or between 4.11 and 4.14 is our headline OPEX been. We expect it to be holding pattern around 4% level, between 4 to 4.1% level for at least for the next 2 quarters before another downward trajectory comes, primarily as the efficiency of many of our efficiency building initiatives kick in and take it downward even further. So overall, it will probably OPEX plus credit costs will remain in the corridor of between 6 to 6.5% for the next 2 to 3 quarters.
Right. And give us the sense, next 5 years, is the ROA going to be linear towards 3.8? Because that's what you've given in terms of the very ambitious guidance for 2031.
Yeah, so our guidance for Lakshya 2031 goals are an ROA in the corridor of 3 to 3.2%. As you know, we are currently at 2.4%. Our guidance is that exit Q4 FY27 will be in the corridor of 2.8 to 3% with a bias towards 2.8%. So our sort of movement to that 3 to 3.2% sort of ROA trajectory is probably towards the latter part of the Lakshya 31 cycle, which between the between FY29 to FY31. It all depends on how the credit costs pair up, because the credit cost guidance is also there as part of our Lakshya 31 goals, is about less than 2%. As you know, we are implementing our Cyclops credit engine across all our lines of business. This quarter we have given out the actual performance in slide 20 of our analyst deck as to the performance of our AI engine vis-a-vis the entire industry, and our engine is outperforming the industry by a wide margin. So we expect the easing of credit costs to continue. Again, what we have said is that these targets will be achieved sometime during the Lakshya 31 cycle, and we are hoping that we are able to achieve that corridor of 3 to 3.2% sooner than in the latter part of the cycle. Geopolitics, as well as overall domestic economics, as well as the dynamics of every line of business, play a strong role in the final trajectory. But we are very, very hopeful that the solid execution that we have built, the strong focus on tech, the strong credit discipline will help us deliver a sustainable and measurable growth in ROA towards that 3% to 3.2% level.
Great. Sudipta, great chatting with you today, and we'll definitely tap in for a longer conversation as well next time. Thanks for your time today.